Good afternoon, everyone. Happy New Year. So today, I think I'm going to take you through the Asia landscape for 2024 and our expectations for the market performance this year. So to set the overall framework, we are going to run through a few key points. Firstly, in terms of rethinking the overall landscape for Asia and how Asia is actually transforming and how Asia is actually contributing in the global economy. And lastly, where can you capture opportunities? This year, I'm going to say that it's going to be a slowing growth year. As you can see, in terms of the data points coming out from the global PMI numbers, it's slowing contraction. You got your services, composite, and manufacturing all on the decline. So this is the framework that we're setting up for this year, that is going to be a year of slower growth. Across developed nations and also emerging markets, this growth is going to slow. And in particularly in developed nations such as US, Europe, UK, Japan, it's significantly slowing. And most of these markets will probably hit a recession sometime this year. The good point coming from Asia is that two key markets, which is China and India, is going to see a rebound in GDP growth, as you can see on the chart here on the left-hand side. And also, this is also going to be driven by nominal investments and private consumption. While growth is slowing, the monetary policy that central banks around the world have continued to stay high, right? So the interest rates continue to stay elevated. And this is going to be high for longer. As you can tell, the recent Fed minutes that came out end of last year, they have highlighted that they will continue to hold interest rates at current level until they see weakness in overall jobs data. Coming closer to home, China. I think everybody is very concerned about China, right? Show of hands, who anybody wants to know more about China? Yeah, I think everyone wants to know about China. Okay, China here, I think everyone is concerned about the major event, which is, are they going into a slowing growth mode, which is similar to what happened in Japan back in the last decade. We say no. And why is it no? It's because China currently is rebalancing its economy and it's not retreating. When we say rebalancing, it's actually they're rebalancing from an investment-led, property-heavy mode to more of a consumption-based mode. And this is actually being driven because, firstly, China's population has grown. Wealth has been created for their citizens. At the same time, this money has to find a home. So a lot of them are actually, they went into property, they're fueling their investments. At the same time also, the government is also pushing forwards transition. They are transitioning from the old school economic business to the new school economic business, such as AI, advanced manufacturing, your renewable energy. So going forward, I think China will transit from having your old school businesses to the newer infrastructure type of business. China, I think everyone knows, have three things that are big issues now, which is the 3D. What is the 3D? Debt, demographics, and deflation. As you can tell on the left-hand chart here, overall China's debt to GDP growth has surged tremendously over the last few decades. And in terms of the debt to GDP levels here, it's comparable to what has happened for some of the markets, like including US and Japan. And I think here, the situation here is compounded with the overall slowness in the property market, which has actually dragged down the purchasers PPI index. And here you can see that on the bottom left-hand chart here, there's the worry of whether China goes into a deflation mode. Okay, and the last part on the right hand, you can see that Japan overall demographics is also slowing. Is actually getting older, and in the context of this, a lot of people are very worried that whether China is similar to Japan in the last decade. Our thesis is actually no. It's first of all, Japan during the 80s, they went through a property bubble, and this property bubble was fueled by speculation. In the China's context, China actually didn't have a property bubble. The only bubble that happened was because they actually oversold properties. Asset prices were not that high, but the problem with in Japan, during the last decade, there was a lot of speculation by corporates and individuals compared to in China. And then China now also have learned their lesson that debt is not the way to go to fund growth, and they're actually trying to control that. At the same time, they're restructuring their property industry. So we come to the next part, Asia's transformation story. So how do we transform in this context where you have slowing growth? In Asia, we identified 3 catalysts that will drive this region. Firstly, is that we have a diverse economy around this region. Secondly, we have enablers in this region. And lastly, we have opportunities in terms of the specific sectors. Okay? So when we talk about key rebalancing enablers, so I give you an example like China. China have a fantastic infrastructure, they have fantastic connectivity, and also the policies in place. And it's run by a central government. And if you compare this with the West, if you have visited some of the countries in the West, you can see that infrastructure in the West is very old. Take example, the US. If you ride their subways, you definitely see their subways are very old. And if you go to China, you can see their high-speed rails, fantastic. So a lot of infrastructure in China has been put in place by the government, and they are modernizing their infrastructure over time. At the same time, we also see that they have come out with a lot of skilled workforce. So in China, you can see that they have a huge amount of graduates coming out from their university, and they have a lot of these are all engineers. They are smart people, okay, smart students. And this will actually contribute to the economy overall in terms of advancements, okay? And in terms of opportunities, and when we see opportunities in this region, we are seeing that it's actually opportunities driven by consumer, technology, and green investments. In 2023, last year, we did a study. Okay, so this study is we asked why global businesses look to this part of the region for opportunities. And the results from that study came out to be that a lot of the times they focus in Asia, the focus for corporates in Asia is because consumer expenditure is going to increase over time. And this consumer expenditure is going to hit 30.4 trillion by 2030, a CAGR of 8% growth from 2020. And how is this happening? You ask yourself, I think everyone nowadays will have a handphone, right? So you are spending a lot of time on your handphone doing your purchases instead of going to the brick and mortar shops. And most of the time you will be doing window shopping instead of actually clicking on your mobile phone. And I think nowadays everybody are buying stuff from Shopee, your Facebook sellers, TikTok shop. So I think this is going to continue over the next few decades or so because the demographics or even the purchase habits of consumers have changed. And hence, this is in line with overall penetration rate for internet users in this region, which is continuing to grow. During our survey of this for business leaders, we asked them, which country do you most want to invest for growth and transformation opportunities? So number 1 here came out to be India. Second, China. Third, Indonesia. And Malaysia is on the bottom 3, okay, for specific reasons lah. Okay, so but you can see that China, India, Indonesia, what are they well known for? Cheap labor. Although China now labor is expensive, but definitely in the past labor was cheap. I think the infrastructure is in place and also the skilled workforce. So, and when they look at investments in this region, what are they focused on? They focus on the few points here, which you can see, the 6 points: manufacturing, healthcare, financials, digital economy, electrical vehicles, and renewable energy. All these are all available in India, China, and Indonesia. When you talk about renewable energy, China is famous for it. The number 1 player now for automakers for renewable, for EV cars comes from China. They have become the largest auto player, even exceeding the previous player in Germany, which is Volkswagen, right? Digital economy, India, China, Indonesia, they are well known for digital economy now because a lot of their transactions are all done online. Okay? And when we think about the context of how Asia is going to drive growth over the last few decades, there's always this paradigm where we call it the Asian flying geese paradigm. And in the past, when we had Japan right at the front, okay, Japan was leading in the 80s, 70s and 80s until when they went through the last decade of the 90s. Then they continued to follow with Taiwan, Korea, and ultimately China. And now China also, as you know, has taken a step back because they are slowing. In the past, China used to grow between 6 to 10% in terms of GDP growth. I think now, at the average growth rate, as you know, the Chinese government has actually guided close to 5%. And going forward, we expect the countries in this region will continue to take over. So they will take over one by one, okay? And this will contribute to the growth dynamics in this part of the region for Asia. And for the importance of how Asia is in the global export, wealth creation, and technology innovation, here are 3 tables that you can see. We basically export quite a significant amount in terms of goods and services, close to 20.7 trillion, and expenditure spending 30.4 trillion, and in terms of patents applications, we control close to 152,000 applications of patents in terms of, and in quantum, it's actually 54% of global patents filed with the patent agency. That's significant. And what that tells you is that innovation is happening in Asia. And lastly, in terms of the financial markets, all our financial markets are available for your investment purposes. Here, the largest one will be China, which dominates, followed by Japan, Hong Kong, and India. So the third point we come to is how Asia stands out in the global economy. Over the course of the next 10 years or so, we expect overall GDP to be contributed from Asia close to from 100, out of the total 153 trillion in terms of nominal GDP, half of it will come from Asia. And in the supply chain, if you talk about supply chain, you can see that over the course of the last few years, during the time where Donald Trump came in with the trade war with China, you can see that US has actually slowed down their purchases of coming out from China from 65% to 50.7%. The thing is, right, this is because over time, US feels that China is a threat. It is becoming a superpower. No longer the sweatshop of the world manufacturing cheap goods. In the past, China used to manufacture furniture, clothes, and household applications. But now, China is focused on the high-end manufacturing, advanced manufacturing, AI, advanced renewable vehicles, and etc. Think about it. China is always being penalized by the US over the course of the last few years. They come up with sanctions on them, right? But I was just reading up over the Christmas, last Christmas, and I just thought about it. Did you know that 70% of toys come from China? And suddenly, if China says, I don't want to manufacture toys, I want to ban toys into the US, I think all the children in the US will be up in arms. And they'll go and demand their parents, don't ban China or play, okay, don't let them sell us the toys, right? So I think this is the context I want to make. The US always sees a threat with China, but China has been very, very nice. They continue to manufacture goods for the rest of the world. And I think internally here, we can see that China is smart. Although they have pressures around the world, they continue to innovate. So in this context also, we talk about Asia, we are having a very comfortable environment now. We are actually returning to the low inflation environment. So overall, the inflation pressures in this region is not significant compared to the US or developed markets. And in absence of any oil spike currently, even though we have the Middle East turmoil, the Russian-Ukraine crisis, there's not much pressures coming from volatile oil prices. And when we talk about Asia's debt profile versus the US and the Eurozone, we can clearly see that, in terms of the debt to GDP, the government debt is significantly lower. On the bottom chart here, you can see that Asia's debt is actually much lower for Asian governments, which means Asian governments can actually pump prime the economy and incur more debt to stimulate growth, compared to the developed markets of Asia and Europe. Okay? And this is really happening. We can see that in countries like India is actually focusing on private capex investments, and you can see the chart is actually on the rise. In terms of cumulative public-private partnerships for countries like Indonesia, Philippines, Vietnam, and India, it's also on the rise. And even in Malaysia, we have seen that happening, okay, public partnerships. And this is significant because overall, it will contribute to the overall economic growth for these countries. And then we come back to China again, okay? Everyone is worried about China, but I just want to tell you, don't worry about China. China is transiting, okay? They're transiting from the old school businesses to the new school. And what's happened? Since 2017, the chart here you see, The change in world goods export shares versus December 2017, China actually increased their market share in terms of global exports. It rose 1.8%, selected oil and gas producers by 1.8% for China, and the export share is close to 15.2% overall for the world. Okay, and how did they do that? They used to do exports of your furniture, your clothing, your household applicants. Now they are focused more on high-end advanced manufacturing. So they are actually selling lithium ions, solar cells, and electric vehicles. So that's actually taken over. So they're moving towards advanced industries. So how do we capture opportunities in Asia? We categorize Asia in terms of the different quadrants. So the quadrants here we identify here are the economic powerhouse, which is China, India, and Japan. We have the East Asia cornerstones, which is South Korea and Taiwan. Financial hubs, Hong Kong and Singapore. And regional contenders, which is Malaysia and Thailand. And emerging players, Vietnam and Indonesia. Okay? But today, I think I will take you closer towards Korea, Taiwan, and China. The reason being is because the applications that we're going to use are coming from this region. The biggest breakthrough will be AI. Okay, so artificial intelligence going forward is going to be significant. As I guided a lot of investors throughout the past in history, if you look back in history, we started off with the black and white TV. Then you move on to radio, your CD, your PC, and then you came to the internet era, which is your PC, and then after that you came out with your iPhone, smartphones. Now we are moving to a different era, which is the AI era. Okay, a lot of these applications will require data mining, and it's generated by back-end application. Okay, who are the biggest players in this region? As you can see here, mostly are dominated by the West, the companies mostly in the United States. All those companies would require a manufacturer in Asia. We have already identified who are all these manufacturers, from the foundries to the independent design makers, to PCBs, to transceivers, to network switch. Almost everyone is in this part of the region. Okay, so that's why I think Asia will benefit when there's an AI boom. Asia's manufacturing advancements would actually support this growth into the AI story. And it's very good because in this context, because the semiconductor cycle is actually bottoming. The recent numbers in November, we saw the rebound in IC demand. Inventories have actually started to stabilize again, and shares of all these semiconductors are very correlated to the semiconductor cycle. And how is this driven? It's basically driven by generative AI. And over the next few years, we will see that software and services will be driving this growth. And I think this growth will continue into it's a multi-year story. We've already seen this happening last year. What happened? Which is the results of NVIDIA. When NVIDIA's results came out, a lot of the Asian tech stocks also rallied in tandem with NVIDIA's results, because NVIDIA produces graphic chips. This graphic chips is actually produced in this part of the region. So I think this is some correlation going on, and we have really seen AI computing enablers, network equipment players, advanced packaging, testing, and hardware also rallying in tandem. The largest player in this region will be TSMC. Okay? TSMC now has become the dominant supplier of AI semi-advanced packaging. They basically dominate in terms of general purpose AI, custom AI chips for their specific customers, and also chips on wafers on substrate. This is a new thing, which is you stack multiple chips onto a particular wafer. It becomes very powerful. In the past, you can only put an IC on a chip, but now you can put wafers on the substrate. And also in Asia, we want to talk about the green drive, right? I think Asia is really ahead when we talk about going green. Asia's renewable capacity is going to grow to 2.4 trillion gigawatts by 2030. And this is actually contributed mostly coming from China and India. At the same time, solar capacity also is going to grow. The dominant player here will be China, and China is the major producer for solar panel production because they own the polysilicon ingots and also the wafers. China is also expanding in wind. You can see that wind capacity is growing in this region. And EV sales, like I highlighted, they are the largest player now, or dominating in terms of EV sales around the world. And you can drive around the streets nowadays, you see so many EV cars on the streets. Korea also is going to dominate in terms of renewable ambitions, where they are actually pushing towards wind, at the same time also hydrogen technology. So we come back to Asia's valuations. So we talk about all those growth drivers, then we look back at valuations and then say, hang on, the valuations in Asia looks cheap, right? But we have so much growth catalysts in this region. Isn't there a disparity? And there's a famous saying by Warren Buffett, so you be fearful when people are greedy and be greedy when people are fearful, right? So this context is like, China now is being sold off by foreign investors, but you have to ask yourself, who is buying the Chinese market? It's actually the Chinese domestic investors. And even the Chinese government, they have their sovereign wealth funds in China, which is actually supporting the market. In the long term, China is transiting. And hence, when we look at the PE valuations of China, currently it's even cheaper than the emerging market PE index. It's at 11.2 times versus the emerging market index of 12.4. Okay? And then on the other side here, you can see that India. India also is benefiting, and you can see that India in the last few years also have seen rising portfolio inflows into their country as they transit into becoming one of the manufacturers, preferred manufacturers after the so-called China Plus One rediversification policy for manufacturers. And India, in the context, have actually done well last year is because the earnings per share also have actually risen in tandem with the overall profitability of corporates. And over the last few years, we have seen that the transition between the context of emerging market constituents, you can see that even China has actually declined, but the other parts of the region, like for example Australia, Taiwan, Korea, have actually increased, and also India and ASEAN too. So when I frame all this into conclusion, we will always want to identify catalysts in specific regions. And here, when we talk about capitalizing on supply chain shifts, where you want to focus in terms of favoring countries which have geographical advantages in terms of cheaper labor, large population in terms of consumer, and also abundant resources, then you should look at emerging market equities, Indian equities, or ASEAN equities. But if you want to look at generative AI in Asia, then you should actually take a look at tech-related Asian equities, and primarily between Taiwan, Korea, and China. And lastly, if you are positioning for a recovery in China, if you think this year, yes, China is still transiting, but ultimately they will have to slow down and rejig the economy, then there's more probability that China has actually bottomed, then you should look at China A and H shares. So in conclusion, I think it's very important for investors, everyone here today, to basically rethink the macro landscape and set your expectations correctly. This year is a year of slowing growth, but there's still opportunity to be made in Asia. Okay? And this is because the Asian diverse region provides a lot of catalysts and enablers to actually generate wealth, exports, and innovation. And lastly, I think Asia is very leveraged to the AI supply chain, and I think this is something that you should not miss, because a lot of this technology advances is actually coming out from this part of the region, which is Asia. And to conclude, we have a particular fund which we've been selling over the last few decades. Dynasty Equity Fund. As you know, it's actually a Greater China fund. But did you know that currently 40% of our investments are actually in Taiwan? And we actually leverage to Taiwan's AI advancements, while the remaining 50% is actually in Hong Kong and China. And in China in particular, we actually focus on advanced industrial manufacturing companies. And this is mostly in the A shares, and also at the same time renewable energy and EV vehicle makers. Okay? And I think here, to put into context, this fund is still driven by technology. Close to 50% of the fund is actually driven by tech. And tech specifically is leveraged to the artificial intelligence supply chain. So I'll leave you here, and I wish you all having a very good investment session for the year 2024 of the Dragon. Thank you.